Welcome to AI Unveiled, Hype versus Reality.
Today, we're following up on the CoreWeave IPO outcomes and testing our own predictions. Let's see how we did.
The financial architects of AI.
The grand spectacle of CoreWeave's IPO has finally played out on Wall Street's stage, not with the triumphant fanfare its architects envisioned, but with the sobering reality of market skepticism. Priced at $40 per share, well below the initially targeted range of $47 to $55. This offering reveals the first fractures in the foundation of AI's valuation cathedral. Meanwhile, Nvidia continues its strategic conquest in the shadows, advancing talks to acquire inference provider Lepton AI, a move that would place the chipmaker in direct competition with companies like Together AI, while further vertically integrating its dominance across the AI stack. After 25 years navigating technological frontiers, I recognize the choreography of power, the intricate dance of capital, computation, and control. Today, we'll decode the hidden patterns behind these seemingly separate developments, revealing the masterminds orchestrating this elegant yet precarious financial symphony.
Section 1. The Grand Illusion. CoreWeave's IPO Reality.
The curtain has risen on CoreWeave's long-anticipated debut, and the market has delivered its verdict. Priced at $40 per share, below the initially targeted range of $47 to $55, the offering provides our first glimpse into how public markets are evaluating AI infrastructure companies beyond the frenzied realm of private valuations. This pricing reveals what I've long suspected, that beneath the gleaming surface of astronomical valuations lies a foundation of financial engineering that may not withstand the scrutiny of public markets. Behind this offering stands an intricate web of financial relationships, with hedge fund Magnetar Capital emerging as the master orchestrator. Through a series of calculated moves that began with a $50 million loan 4 years ago, Magnetar transformed its position into a multi-billion-dollar stake, while artfully protecting itself from downside risk. What's particularly revealing is how Magnetar structured its investment. They secured penny warrants, collateralized loans against CoreWeave's high-end chips, and even negotiated put options, allowing them to sell back stakes if the stock falls in the 2 years following the IPO. This sophisticated approach represents the antithesis of traditional venture capital, prioritizing downside protection while maintaining maximum upside exposure. In my discussions with executive leadership teams across Fortune 100 companies, I've observed growing recognition that pure technology assessment is no longer sufficient. Understanding these complex financial structures has become essential to evaluating the true sustainability of AI infrastructure investments.
Section 2. The round-tripping revelation.
The confirmation of Nvidia's dual role in CoreWeave's ecosystem perfectly illustrates the round-tripping phenomenon I've previously highlighted. Fresh from today's IPO disclosures, we now know Nvidia owns approximately 3% of CoreWeave after investing about $100 million in early 2023. That stake is now worth more than $700 million at the IPO price, a seven-fold return on paper. Simultaneously, Nvidia committed to spending $1.3 billion between 2024 and 2028 as CoreWeave's second-largest customer. This creates the circular financial arrangement I've warned about, where a strategic investor provides capital that flows back as revenue, creating artificial growth metrics that justify ever higher valuations. This arrangement allows Nvidia to cleverly engineer its own growth narrative, funneling investments into CoreWeave, then conveniently counting those dollars as customer revenue, effectively inflating market perceptions of demand, while CoreWeave capitalizes on Nvidia's orchestrated illusion of demand, enticing public market investors into shouldering the risk of its inflated valuation. Similar patterns may emerge if Nvidia acquires Lepton AI, whose founders previously worked at Meta on PyTorch. This strategic move would give Nvidia direct control over an inference provider serving AI developers, further extending its dominance across the entire value chain. What we're witnessing across the industry is Nvidia orchestrating a comprehensive strategy to control not just the hardware layer of AI, but increasingly the software and service layers as well. In this grand chess game, each acquisition and investment represents another piece positioned for maximum leverage.
Section 3. Traditional VC absence. The capital intensity barrier.
One of the most telling revelations from CoreWeave's IPO journey is the conspicuous absence of traditional venture capital firms among its major backers. As we learned today, CoreWeave's financing came primarily from non-traditional sources: hedge fund Magnetar Capital, retail billionaire Leslie Wexner, former commodities traders, and an eclectic collection of friends and family of the founders. Why did Silicon Valley's prestigious VC firms miss this opportunity? The answer lies in CoreWeave's capital-intensive business model. As venture capitalist Nick Carter noted regarding CoreWeave, a lot of VCs have a blind spot. The conventional wisdom as a VC is, you don't want to do a capital-intensive business. This reluctance created the opening for Magnetar, which recognized that CoreWeave's inventory of high-end Nvidia chips provided tangible collateral, a stark contrast to the purely intellectual property-based investments that VCs typically favor. The divergent approaches between CoreWeave and Nebius become even more instructive in this context. Nebius has achieved 462% year-over-year growth without accumulating massive debt, instead funding expansion through equity and operating cash flow. This approach may not generate the same explosive growth metrics, but potentially offers a more sustainable path forward as market conditions evolve.
Section 4. The financial engineering virtuosos.
The tale of CoreWeave's journey to public markets reveals the true virtuosos in today's AI economy, not necessarily the technology architects, but the financial engineers who structure investments to maximize returns while minimizing risk. Magnetar Capital stands as the quintessential example. Its name appears 157 times in CoreWeave's IPO prospectus, more than twice as often as CEO Michael Intrator. Through a sophisticated combination of debt instruments, equity investments, and protective provisions, Magnetar positioned itself to profit handsomely, regardless of CoreWeave's ultimate fate. Even more telling is how early backers have already secured significant returns before today's public offering. The three founders cashed out roughly $500 million of their holdings in 2023 and 2024. Early investor Stephen Jameson, a former natural gas trader, sold about $60 million worth of shares in previous tender offers. Leslie Wexner's trust sold approximately $71 million in a 2023 tender offer. These transactions tell a story of sophisticated investors securing returns while transferring risk to public market participants. Many funds that bought in November at $47 per share, including Jane Street, Fidelity, BlackRock, and others, find themselves underwater at the $40 IPO price. As I've observed throughout my career, market frenzy often enables this transfer of risk from early, informed insiders to later-stage investors swept up in the excitement of a seemingly revolutionary technology.
Section 5. Nvidia's master strategy. Unveiled.
Looking at today's twin developments, CoreWeave's IPO and Nvidia's pursuit of Lepton AI reveals Nvidia's masterful positioning at the center of the AI infrastructure landscape. Nvidia has methodically ensured it profits, regardless of which infrastructure provider ultimately dominates. It owns approximately 3% of CoreWeave, less than 1% of Nebius, and now seeks to acquire Lepton AI outright. This diversified approach represents not merely financial hedging, but strategic positioning to control critical choke points across the AI value chain. The interest in inference providers extends beyond infrastructure companies to model creators themselves. OpenAI, Anthropic, and Meta platforms all recognize that as models like GPT 4.5 or o1 Pro become increasingly compute-intensive, optimizing inference costs becomes a strategic imperative. Magnetar's deep involvement in AI infrastructure extends beyond CoreWeave. Bloomberg reports the firm is expected to write one of the largest checks to OpenAI, also a CoreWeave customer, in OpenAI's $10 billion funding round this month. Meanwhile, Magnetar, has launched a venture capital arm to leverage its relationship with CoreWeave by investing in new AI startups in exchange for access to Nvidia chips. These interlocking relationships create a tightly woven ecosystem where capital, computation, and strategic control flow through carefully constructed channels designed to maximize returns for those sophisticated enough to architect them.
Actionable takeaways.
For investors, executives, and technologists navigating this landscape, I recommend 3 specific considerations in light of today's developments. First, recognize the power of financial engineering in shaping AI infrastructure valuations. CoreWeave's path to public markets demonstrates how sophisticated financial structures can generate outsized returns for early investors with protective provisions, while potentially transferring risk to public market participants. Second, understand that optimization capabilities will become increasingly valuable as AI deployment scales. The strategic interest in inference providers like Lepton AI highlights how companies that maximize performance from limited chip resources will command premium valuations. Third, expect continued consolidation as strategic players secure their positions across the AI value chain. Nvidia's comprehensive approach, investing in multiple infrastructure providers while potentially acquiring direct service capabilities, represents the emerging template for vertical integration. Today's developments confirm what I've long suspected, that beneath the gleaming surface of AI's exponential growth lies a complex foundation of financial engineering and strategic positioning. The true winners in this technological revolution may not be those who develop the most advanced models or deploy the most compute, but rather those who master the intricate dance of capital allocation, risk management, and strategic positioning. By distinguishing between genuine innovation and financial engineering, we can better identify sustainable value creation amidst today's investment frenzy. The AI infrastructure landscape is being shaped not just by technological breakthroughs, but by the invisible hand of financial architects designing structures that transcend traditional boundaries between investing and operating. As always, I'm Asif, helping you separate signal from noise in the AI revolution. Until next time, stay vigilant and follow the data, not the hype.
At nxtg.ai, we continue to help enterprises navigate these complex waters, separating genuine AI opportunities from costly distractions. The future belongs not to those who simply adopt AI, but to those who structure intelligent partnerships that create lasting value.
AI Unveiled is produced by nxtg.ai. For AI strategy consulting, visit nxtg.ai or connect with me on professional networks. Subscribe to AI Unveiled on all major platforms and join our community of forward-thinking leaders navigating the AI revolution.